My name is Michael Duke, and this is my show where I analyze stocks that I think are interesting. And if you're interested in that type of content, you want to see more of it, then please consider subscribing to my channel and liking this video. And if there are companies that you're interested in that you feel that I could weigh in on positively and perhaps uh, confirm or shift your perspective on, then please feel free to comment. And that's why I'm so excited about today's video, because this is a first time for my channel, the first time that I am doing an analysis on a viewer suggested company. So shout out to Ryan Romero 4095 who commented on my video analyzing Hershey stock yesterday. He requested that I do a video on Procter and Gamble. So as promised, that's what I'm doing. So as usual with the format, if you're familiar with my videos, I just go over a description of the company first, talk about the thesis as to why it may be compelling, discuss the moat, either the presence or lack of an economic moat. I'll do some analysis of the financials, the valuation, and dividend, if it has a dividend, which this does, very notably so. I'll also briefly discuss the risks that are apparent to me in investing in this company. I'll also give it a grade. Is it a buy, a hold, or a sell, in my opinion? And then I will. Sometimes I talk about risk parity, things that you can enter into, corresponding longs that may give you some risk parity. I won't be doing that on this video just because nothing immediately comes to mind without doing some sort of sophisticated numerical analysis. And last but not least, as usual, I will do some basic technical analysis as well. So without further ado, let's get into it. So Procter and Gamble, this company is very large, over a $400 billion market cap, large cap US based company. This is a company that's very noteworthy and visible given its large size, but also its ownership of a lot of very recognizable consumer product brands. It's been around since 1837, so very mature, very large company with a significant presence. And in fact, if we look at some of the brands that they have, this is on their website here. You probably recognize a lot of these brands. The ones that stick out to me in terms of baby care or products: Pampers and Loves, diapers. We have, fabric care, detergent, stuff like that. Bounce, Downy, Gain, Tide. Those are all brands that stick out. Paper towels, toilet paper, facial tissues. Familiar with all these brands. Feminine products, very notable. Grooming, men's and women's. Skincare, razors, Gillette, of course, very notable. Braun. Hair care, lots of, shampoo products or deodorant, skincare, Old Spice, Pantene, herbal essences, Head and Shoulders, Aussie, Febreze, Cascade, Dawn, soaps, kitchen products, Mr. Clean, Magic Eraser, Swiffer. So lots of very visible, noteworthy, large brands. And I don't have data in front of me that discusses market share here, but I would not be surprised if all of the brands, including ones that weren't even in that list, we see here, they have healthcare products like Metamucil, Pepto-Bismol, Vicks, lots of very notable consumer staple brands. And like any consumer staple company, the reason that an investor would be interested in a company like this is because of its intangible assets, its brand equity. Consumer staple products, in theory, should be more resilient to innovation and technological disruption. Artificial intelligence is not going to disrupt chocolate bars and confectionery products. Similar story here in terms of consumer staples products. So why would this company be compelling to a potential investor? Well, I think it's pretty straightforward. Intangible brand assets that realistically and conceivably can be continued to sold for centuries. Again, this company's been around since the early 1800s. So that's why it is interesting. And of course, it's fairly apparent that it is a wide moat stock. So, what narratives are driving the price? Well, there are no negative sentiments. You see here, the company is trading close to its all-time high, just off of its all-time high of almost $180 a share here. So when it comes to companies like this, they tend to trade at a premium valuation unless there's some sort of negative news or sentiment surrounding them. I do think that stocks like this are not of good value unless there is a short term sell off due to a temporary newsworthy event. Again, that's why I like Hershey stock as a counterpart, because there's a lot of negative sentiment and their business results are poor right now. However, this stock, there isn't really anything wrong with it right now. So that's good. If you're not necessarily looking to outperform the market, you just want stable, safe dividend income that's increasing at a rate above inflation. You might already be invested in this or have it on your watch list. I personally do not own any shares of this company. I own companies like this and can definitely appreciate the value proposition that this company provides. However, there is nothing wrong with it right now. But before we, grade it and whatnot, let's just look at their numbers first. Looking at the income statement on an annualized basis. So this goes back to 2015 revenue in that fiscal year being just under 71 billion, and is in the trailing 12 84 billion, roughly a 20% increase over that time frame, over a 9-10 year time frame. Pretty slow, low single digits compound annual growth rate. Gross profit from 33.7 billion to 43. Gross profit is increasing at a rate greater than revenue growth, implying pricing power stemming from intangible brand assets. You want to see gross profit increasing at a faster rate than revenue because it is indicative of continued brand equity. Operating income from 13 billion to 21 billion. That's more than 50% in that time frame. So not only are gross profits and therefore gross margins look pretty good, but you see here that their OPEX is relatively flat over that time frame, not increasing hardly at all, implying that their brand equity is strong and they're not having to plow a bunch of additional money into marketing to continue to sell their products. We're looking at like low single digit revenue growth, mid single digit earnings growth, or pure organic profit growth. Again, what's important to note is the degree to which financial engineering has on the earnings per share growth. We see basic weighted average shares outstanding in the earliest period observable here, 2.7, and is now 2.35. I want to say that's roughly 20% reduction in share count over that time. But again, pretty good looking financials for a company of this. We see, most of the time revenues are going up slowly. Gross profits are growing up slightly quicker. Operating income growing up even quicker. And they are using cash flow to buy down shares and pay dividends. In fact, the dividend per share in the 2015 year, 259 a share, now 389. Payout ratio is a little high. Some of these years it's been greater than their earnings, but they have continued to return lots of capital to shareholders. The most recent trailing 12 payout ratio, 66%. Let's take a look at their balance sheet. Cash equivalents, just a shade over 12 billion. Again, the biggest asset that a company like this is intangible in their brand equity. Long-term debt has been going up steadily over that time, from 18 billion to 26 billion. That's 40% over that time. And retained earnings going up. That's good. We're not distributing too much of the cash. So Again, pretty good looking financials for what this company is, but nothing about it. When I look at it, it's not sexy, it's not exciting, it's boring, plotting, stable, is what it looks like to me. Let's take a look at the dividend and a couple other valuation metrics. Free cash flow yield, about 4%, just under 4%, or hovering around. Honestly, that's pretty low, I would think, implying a fairly high valuation. How does that stack up on, dividend discount valuation? Well, you see here over the last 10 years, the dividend is pretty much at the lowest or close to the lowest that it's traded at within the last 10 years. So what I see here is a valuation that looks fairly elevated, doesn't look like a good value. The valuation is relatively expensive based on those numbers. If we look at, the Seeking Alpha valuation metrics, more of the same. The price earnings growth ratio, non-GAAP 3.6. That's pretty high. The price sales ratio, an enterprise value sales ratio of this company is very, very high. 5 times sales for a company of this size seems like a lot to me. Price earnings ratio forward looking in the mid 20s. I would agree with the valuation grade here, D minus. It is an expensive looking stock to me. It's not indicative of value. So yeah, you're looking at the financials of a strong, stable business. However, it does appear that it is trading at a premium. Is it trading at a premium relative to history? Let's take a look at the price earnings multiple over time. I don't immediately know what's explaining that, but worth another look. So on December 3rd, 2014, trading at a 23.78. This is on a GAAP basis today, trading at a 30, implying some multiple expansion. Not too uncommon with a lot of stocks in today's market. I recently did a video about Republic Services, the waste collection company. They had pretty egregious multiple expansion over time. Another stock that comes to mind is Costco. So some modest multiple expansion of this company over time. And that has definitely been the case within the last year. The multiple has expanded, implying fairly bullish underlying sentiment in the marketplace. So let's talk about the risks. I'm gonna scoot over to the annual report to discuss this. I think when you're talking, it really does depend on what you're investing for. If you're investing primarily for a dividend, and you're somewhat agnostic to the starting yield, and what you're just trying to buy growth at a reasonable price, lock in a good starting yield that is growing at a rate that conceivably could outpace inflation. The risk to entering this investment now, I would say, is fairly low. But that being said, as a company like this, we take a look at their net sales by region here. So only about half their sales in North America, less than a quarter Europe, and then the rest of the world there. So they do have a large presence across the world. That, of course, introduces some modest level of currency risk. Now, one thing that has been true in recent years, uh, largely driven by COVID and relative levels of inflation, is that the dollar has appreciated versus the euro. It's appreciated versus the Chinese yen, appreciated versus other major currencies, more so than not. So while there is a large amount of dollar exposure and that being strong, there is some currency risk. And of course, with a company like this, you also have, litigation risk if there's some sort of like recall with one of their products because it's, a lawsuit about health and safety concerns to consumers. Stuff like that can emerge and really tank the price temporarily. I would say that the primary risk of investing in this company is simply opportunity cost. Let's just look at the total return here. Opportunity cost versus just investing in the index or other opportunities that might be more compelling. So we see, really, regardless of which time frame I choose, the stock has underperformed on a total return basis the S&P 500 and pretty much had the same beta. In fact, in the most recent bear market, it did draw down almost to the same degree. It did outperform slightly. Um, so it is fair to expect a company like this to outperform in a bear market and underperform in a bull market. That's exactly what we're seeing. So what are the risks? What's the biggest risk to investing in this company? It would be an expectation that it will underperform the index. And the main driver of that is it's already huge. It already has a big valuation. Of course, many companies in the S&P 500 are as well. So I think there is a level of sentiment when an investor looks at a market cap company, one like this, $400 billion, that's growing in the single digits, and says, how much bigger can this thing get? And is it the best opportunity? Now, as is typical with a company like this, we see here, it has outperformed the index on a total return basis, but that's a 30-year chart. So if we look again at price return instead of total return, again, 2,200% versus 1,200% on a total return basis, has underperformed in terms of price return. So the outperformance is coming from the dividend. So let's talk about the dividend for a second. Dividend, it has paid or grown dividends for 68 consecutive years. The 5-year compound annual growth rate of 6%. That has roughly outpaced inflation over that time. The CPI today, being less than 3%. It's projected that the dividend here is going to grow roughly at that same 6% clip going forward. Here they say 4.2. However, earnings per share growth is projected to be 8%. So I think it's reasonable to assume that the dividend, at least in the short term, immediate term, the growth of it will outpace inflation. So again, if you're a dividend investor, I mean, look at this. I think this only goes back so many years. They've paid out dividends many more years than that. I think they highlight that here somewhere in the annual report. So yeah, main risk here is this is a slow and steady investment. And if you invest in this, you conceivably and realistically can expect to increase your dividend year after year for the foreseeable future. However, your total returns, I believe, will not eclipse that of the S&P 500. So that's the main risk. Fairly benign risk. It may have better risk adjusted returns. We see here 134th consecutive year that it's paid a dividend. Only 7 US publicly traded companies have paid a dividend more consecutive years, and only 3 companies have raised their dividend more consecutive years. So you can see why this is somewhat of a darling in the community. We roll over to Portfolios Lab to take a look at it. Price earnings growth ratio 3.72 on here. Again, trading basically at an all-time high. That's an expensive price earnings growth ratio. It's not indicative of value to me. Again, I did analyze Hershey stock. This stock has performed better than Hershey in recent years on a risk-adjusted basis, on a total return basis. However, because it is in the dumps, it looks like a better value to me. But let's talk about risk-adjusted performance. This is the rolling 12-month Sharpe ratio. We see here the Sharpe ratio tends to lag during periods of bullishness and tends to outpace the index in periods of bearishness. That's what kind of like the bare minimum of what you should expect from a company like this. And further taking a look at the drawdown chart, we see, when the last 2 times it's really drawn down significantly, Procter Gamble has outperformed. However, there's been periods here where it has been more volatile than the index within the last 10 years. So coming back to volatility, it is slightly more volatile, as really any individual stock would be. So here's the deal with this company. I don't know, guys. I like it. I see the value proposition. I see why somebody would want me to look at it, why somebody would want to invest in it. However, for me, I'm going to grade it a hold. If you have shares, there's really no reason why you should sell it. you should expect fairly modest performance for a while. If you're looking to enter a position, I do believe that there are much better opportunities out there. And if you're, wondering what those might be, then take a look at some of the other videos I've made recently, and follow me on Seeking Alpha. I write articles. I'm a contributing author on there where I put analysis. So that's all well documented, and I continue to highlight those opportunities. So I grade this a hold for the majority of investors. I would say if all you're caring about is dividends, then this, still looks attractive somewhat. Let's just draw some lines on this chart. What's going on? Come on. Again, for the keen observers out there, you will note my crude methods of technical analysis. This line is a little wonky here. This is not necessarily a clearly identifiable pattern. In the most recent bear market, it did break down somewhat. It's not a clear trend line, but it did break down below and bounce back. And it's now in this wedge here. So in terms of the price, it did bounce. It did fail to break out of this wedge pattern that it's in. Pretty weak pattern, but it did fail to break out. Volume has been fairly flat. The last time it had significant volume was during the COVID crash. Technically, this chart, it looks fairly bullish, at least from this point on. If it was me and I was looking to enter a position, I couldn't say that I would do it here because common sense dictates that the price could fall all the way back down to 150 something before bouncing back, all other things being equal. So does the chart give a clear entry point right now or indicate a good entry? No, I can't say that it doesn't. It's not really a bearish or bullish looking chart either way. It's modestly bearish at the current price. We see each of these candles here, I believe, is a week. It has sold off for the entire week so far and conceivably could do so all the way down to the mid ones to the trend line. There's a level of support right here in the mid 140s. So I would be cautious if you're, just going to trade this thing and maybe wait for a better entry point. Again, I'm not a sophisticated technical analysis person. The only thing I really reference are trend lines. I don't look at indicators because when I'm entering in a position, I'm doing it for a long-term hold. So just to recap, Procter Gamble, it is a large cap company that owns many, many very, very well-reputed, well-performing consumer products brands in America and internationally. It has strong market share. It's a wide moat stock with strong intangible assets that should allow it to continue generating excess returns on capital for the foreseeable future. It has a very good dividend track record, strong dividend that is growing and has outpaced the rate of inflation for the majority of recent history, and it should appeal to dividend focused investors. However, I give it a grade of a hold. If you're already in it, you understand it. I see no reason to sell it. However, it just doesn't excite me. It doesn't look like a deal to me. I'm perfectly content buying stocks that don't look like they're a great value, but only if I believe that they will grow their earnings, their profits, only if I believe that they will grow at a rate greater than the broader market do I feel comfortable entering into a position in growth at a reasonable price type style. I invest in many companies with that type of profile. I do not believe that this company fits that profile. I think that a company like this is worth investing in at a value price, and I do not believe that it is at a value price. You may feel differently, and I would, of course, urge you to do your own analysis and research, but I grade this a hold right now. So that's going to conclude our video. Hopefully you found this interesting, helpful, and compelling. Please feel free to comment on what stock you want me to analyze next, and I would be happy to oblige. Again, I don't have that many viewers. I just started making these videos a few weeks ago in this style. I've had a channel for years, but just started doing this, just started writing articles on Seeking Alpha to share my thoughts and analysis. So definitely want to make sure that I'm engaging with my community out there, and people who are like-minded and interested in the same things. So with that being said, hopefully you found this enjoyable, and I can't wait until we see each other again. All right, have a good rest of your day, and I'll talk to you soon.